Well, we're 2 months ahead of the general election now. If you look at the majority of the opinion polls, they actually put the Conservatives and Labour almost neck and neck. And what we can say, that unless there's a dramatic shift in the polls, that this is the most uncertain election that we've had for a generation. In terms of the big shifts in the likely balance of power come the next Parliament, the Scottish referendum last year has been a very important event, and although we had a clear no vote, what we've seen since then is the implosion of the Scottish Labour Party, big gains from the Scottish Nationalist Party, and it's looking increasingly likely that the SNP will get a large number of seats in Westminster come the 7th of May, perhaps 40 or even 50 seats, and it's not impossible with that bulk representation in Westminster that the SNP could actually hold the balance of power. UKIP's influence is much greater this time than in the last election in 2010. We've seen UKIP rise in the polls, perhaps around the 15–16% level. Of course, they've taken 2 seats in parliamentary by-elections towards the end of last year. The likely arithmetic is such that UKIP probably won't hold the balance of power even if they win some seats. But one of the more interesting questions is who they're going to take their votes from. Will it really hurt the Conservatives, or increasingly likely will Labour fail to get some targets in the north of England where UKIP are making some ground? So it may be that UKIP doesn't play a big role in forming the coalition, but actually it could have a major role in determining the pattern of distribution of seats in the next Parliament. If we look at what markets would prefer on an electoral outcome, certainly currency markets would prefer either a Conservative government or a return of the Conservative Lib Dem coalition. And that's because markets trust the Conservatives with the economy more than they trust Labour. In that respect, an SNP Labour arrangement, perhaps a coalition, would be seen as perhaps negative from a foreign exchange point of view. But one point is that what markets really hate is uncertainty, and they don't want to see the election of an unstable government, or, as is possible, an arrangement where 2 parties don't have enough seats to gain a majority. The Retail Prices Index used to be the main measure of UK inflation, and actually that was the case for decades. What we know about the RPI is that technically it's not a great index. The CPI, the Consumer Price Index, is put together much better in that respect. The CPI, of course, is the targeted measure of inflation as well. And in that respect, the RPI has lost a great deal of credence and relevance. The main exception to that is that the index-linked bond market in the UK is still linked to the RPI and not the CPI. So of course, in that respect, it is still an index which we have to watch carefully. Our view on sterling is that it will begin to take a little bit more notice of the opinion polls and the uncertain outturn, perhaps a couple of weeks ahead of the election. And that turned out to be the case ahead of the Scottish referendum last September. Of course, what happens after the election depends almost exclusively on how the election result pans out. The nightmare scenario for sterling is that it's impossible for 2 parties to form a coalition. That might mean some unstable arrangement where 3 parties try and form a government, or perhaps 2-party or even 1 party tries to form a minority government. That really would be a negative outturn for sterling, and it could mean that sterling falls below the 150 level against the US dollar and stays there for quite some time. I'm not unduly pessimistic about the prospect of a mansion tax being a particularly adverse factor for the City of London and the economy as a whole. But clearly what it is doing is that it's dissuading overseas investors from parking their money in high-end London property. The Greek situation is very uncertain, and of course Greece is part of the Eurozone, and the Euro area accounts for around half of British exports, so what happens there is very important. However, we're not in a situation where the Greek problems are really impinging on the Eurozone economies, as was the case 2.5 years ago. Now we're beginning to see signs that the Eurozone economies are gathering some positive momentum, which makes the UK export market more attractive and larger. Of course, Greece is an uncertainty. Our view on Greece is that it will probably cobble together last-minute agreements, and a third bailout will be arranged by the early summer.